Hello, my name is Michael and today's video is all about the Relative Strength Index, the RSI. I will cover the basics of how it is built, how the formula is calculated, and I'll discuss how to use it in the real market with a strategy based on the RSI. By definition, the RSI is a momentum oscillator that measures the velocity and magnitude of price movements. It is a dynamic line moving in the scale from 0 to 100. The indicator compares the closing prices of the current and the previous candlesticks, indicating the trend strength. Like many of the most popular indicators, it was developed by J. Wallace Wilder. Let's talk about why we should use the RSI. Firstly, because of its universality. It can be used in any market, currency pairs, stocks, you name it. It works at any time frame, but as always, you have to be aware that the lower the time frame, the more false signals it produces. The RSI is the leading indicator, which means in an ideal situation it should give us the signal before the market will move in a certain direction.
Okay, so how to use the RSI? First thing is that it indicates two zones, the overbought zone and the oversold zone. When indicators go above 70 line, it suggests a possible peak. So we would have the overbought zone that probably the trend will change its direction to the downside. And on the other hand, when the RSI falls below 30 line, it suggests that this is a possible max low and the trend will turn around to the upside. Okay guys, and now let's say a few words. What is the difference between the leading indicator and the lagging indicator? The leading indicator moves before the market. It gives us the prediction whether on which side the market will go up or down. The lagging indicator, on the other hand, gives us more of a confirmation. It moves after the market. So, of course, the leading indicator gives us the prediction and we can enter the market quickly, earlier than in the lagging one, but the lagging indicator gives us more of a confirmation and it produces less false signals than the leading indicator. So that is the main difference. In the perfect conditions, the leading indicator should work something like this we have down below. It will give us the prediction over here that the price will go up, over here, and over here, for example, that the price will go down. Alright, and yeah, over here, for example, if the price would go up. So now here it would give us the buy signal, here also sell signal, and again a buy signal. So that is in a nutshell the difference between the leading and the lagging indicator. Now let's look at the calculation formula. First we need to define what RS is, which is the relative strength, and it equals the average of the closing levels from the green candles in the N period, which is analyzed in this indicator, and we need to divide that by the average of the closing levels from the red candles, right, during the N period analyzed in the indicator. Okay, so now let's go further with the calculation of the RS, and the default value is 14 days. So we need to analyze 15 days to have the average of the 14 days closing price, right? So let's calculate them. We have here 2, 3, 2, 3, 4.5, 6.5, 8, 9.5 divided by 14, it gives us 0.68. Now let's calculate the minus closing and the red candles. We have 1.5, it's 3, 5, 7.8 by 14 and 0.57. Okay, now let's further calculate the RS. 0.68 divided by 0.57 from the previous calculation, and the RS is 1.19 for us. Okay guys, so now let's calculate the RSI from this equation. Let's add the numbers from the previous calculation. We have 100 divided by the 1 plus 1.19. So we have 100 minus 45.66, and now that gives us 54.66 number. We divide everything and calculate from the 100 right here and here, so we could get a number between the nil and 100, which makes our scale in the indicator. Okay, we are now in the client's cabinet. Let's check how it looks on the real market, on the real example. Here we have the GJ, the British pound against the Japanese yen currency pair, the M30 time frame, and let's add the RSI indicator to the chart. Once again, let's click on the indicators tab, choose the RSI, and it is automatically added below the chart. Here we have the 70% line and the 30% line. Here is the overbought zone and oversold zone. And right here in the middle, this is the moving average line, the RSI. So, as we spoke before, there are two main strategies that are considered when trading with the RSI. One concerns that when the moving average is above the 70% line, which is when it goes to the overbought zone and exited from above to the bottom, when it crosses the 70% line, that means that probably the trend will change direction from uptrend to the downtrend, and in the opposite direction when we talk about when the moving average crosses, when it is below the 30% line and it crosses the 30% line from bottom to the upside. So let's find some examples of the trades which we could take. On this chart we have this particular situation where we entered the overbought zone. Right here we have, with this candle, during this candle we crossed the 70% line and entered the zone below the 70%, which means we could enter the trade over here and probably end somewhere over here, which is on the 30% line. And on this particular trade, when we trade on the M30 time frame, that would give us 133 pips. So that is pretty high yield, if you ask me, from this simple trade. And as usual, the stop loss and take profit, as you can probably deduct from this following example, the stop loss should be a couple of pips above the highest point before we crossed the 70% line. So it would be a couple of pips above this candle where we crossed the 70% line. So let's make some measurement. We entered here. Let's add, for example, 25 pips. And it would be from 130.14 till 140.14 till 140.39, let's say. Something like that. Okay, another way to trade with this indicator is to look for the divergence. What I have in mean by that? I have in mean that when there is the difference in the movement between the chart and the average and the moving average from the RSI. Let's look for a perfect example. Okay, and here is the perfect example, because guys, as you can see, here is a bit of a choppy road. We see that here the moving average made a higher high. Next one didn't make the higher high, but on the chart we see that the chart moved up. Then we see again on the moving average not a higher high and a higher high on the chart. That gives us this the information that the most probably the trend is weakening. And even though we could set up this scenario, how we could trade this those setups, as you can see here, we could even try when we saw that the new high right here wasn't made, but it was made right here. We could take a trade, would be stopped out a little bit above. So for example 20 pips we would lost here. Then again we could see that okay, there is a reversal right here on this candle. We crossed again the 70% line, entered again, moved down a bit, and then again upwards. So right here we could be, I don't think we could right here set up take profit and close with profit, but rather just at the entry point. Our stop loss would be at this moment. Right now again bounce back up, and we could enter again. We see the divergence because the new high, yeah, is just a little bit, but it's not that significant. On this candle we again see that the moving average line from the RSI crossed the 70%. That would be again our entry point. And from this moment, if we entered here and exit around 30% line, we could get 178-79 pips. So that is 160 pips profit if you deduct the previous loss. So either way we would make a profit. What I want to add to this chart is that what I was telling you before, that always double check your trades. As you can see here very clearly, we have the head and shoulders pattern, beautiful, like textbook example. We have this left shoulder, the head, and the right shoulder, and right here we could enter also the short trade and yeah, make a profit. So here we have this double confirmation that the signal which was given by the RSI, yes, it was fairly early, but later then we could see that yeah, okay, it was the right decision. We probably don't have nothing to worry about for this particular one example. As you can see from the following example, it is not a perfect indicator, and frankly any of the most popular indicators should be used on its own. I would highly recommend you to always double check your trades, always not only refer to one single indicator, only a couple of the indicators. You need to check also the patterns, chart patterns, and the fundamentals, and then decide whether to hop on a trade or not.